Our next presentation up here is going to be best practices for benefit plans and payroll. Come on up, sir. Yep. And it's going to be myself and my colleague Christian Davis, who's joining me up here at the desk here. We're going to be talking now. We gave you this highlight of the different developments and things we're keeping an eye on. But now we're going to talk to you for a few minutes about things that you can do in terms of practical steps when you're working with your payroll and your benefit plans to try and protect the company and just best practices in general. And we're going to go through these. Again, if you have any questions, you can feel free to go ahead and let us know. But we're going to start here first with bonuses and sign-on bonuses. You know, in the tight labor market that's out there, I haven't seen quite as many of these, but I still see these where you're driving by a business and it has a big sign up saying, you know, come to work here and receive a $5,000 bonus or $10,000 bonus. Because of the labor shortages, employers are looking for those. And so when we go through here, not all these may be applicable to you, but we're trying to give things that we think are probably applicable to people and how they should consider them in terms of handling them for payroll purposes, in terms of taxing them and so forth, so that hopefully you can avoid making any mistakes. And so basically a sign-on bonus is when, again, you're hiring a person on. And sometimes an employer might say, how do I handle that? Sometimes you may sign a person on a while even before they start working and give them a sign-on bonus. In that case and in others, generally speaking, at the time you pay a sign-on bonus, that's when it's income to the person. And income and Social Security and Medicare taxes should be withheld and reported eventually on your Form W-2. In contrast, at other times, employers do things I'll call sign-on loans. And these are meant to be sometimes related to tuition or not, but they're something that would be reported on Form W-2 when the loan is forgiven. So that's the big difference is that when is it earned? If there's a loan and you have a valid loan document, it's not earned until it's necessarily forgiven. On the other hand, if you're paying a sign-on bonus, it's taxable when it's paid. And we're going to turn it over to Christian here to go ahead and get into a little bit more detail, especially about sign-on loans.
That's right. And sometimes employers, as Tim mentioned, will offer these loans when they're trying to recruit someone. Maybe they're moving across state lines and they need cash to help them relocate. There are plenty of reasons why an employer might issue a loan instead of granting a bonus in connection with the sign-on. And the important part, just as a threshold matter, is that it needs to be a bona fide loan. The loan needs to have a requirement that it's going to be repaid, although we will get into forgiveness of that loan and what that means in terms of payroll taxes, in terms of taxes generally. The loan documents must include a legally binding promissory note, and the loan must bear a reasonable rate of interest. Now, that's important. The rate of interest is typically tied to the federal rate, which goes up and down monthly. And if there is no reasonable rate of interest at the time the loan is made, then a reasonable interest is imputed onto the loan. And there are exceptions to this. Most commonly, if the loan is $10,000 or less, the employee-employer loan is not required to have the interest rate. And that is also contingent upon the loan not being made for tax avoidance.
Yeah. And so, Christian, we got a question here. And a sign-on loan, you could also see them as like tuition assistance sometimes they're provided. And the question says, if you provide a sign-on loan to a sponsorship program, you're sending students to school and then they come to work for you and you have a repayment, is that still considered a loan in essence to an employee? And the short answer would be yes. If as part of the loan, you're saying, hey, we'll help provide you with this amount for your education, but then you have to come and work for us for a year or 2 years or something, and then we'll forgive the amount. That in essence is compensation, and that is something that you'd have to include in their compensation when it's forgiven to them, i.e. once they've completed the work requirement. But Christian, maybe you could go over this slide a little quickly and then we'll go on to how things are taxed in terms of the tax rate.
Sure. And in addition to the $10,000 exception for interest on loans, the code and the regulations provide exceptions for loans that are made to purchase a new principal residence. I mentioned at the top the loan provided for moving expenses. And then if the loan is subsequently forgiven by the employer, i.e., they're not collecting the repayment of the loan, then the income is realized at the time the loan is forgiven in the amount that the loan is forgiven at that time. And so, as the two sub bullets here say, that means that the employer needs to impute income to the employee based on the amount forgiven and withhold for payroll and employment or income and employment taxes when that occurs. And if the loan is forgiven in installments, only those installments, when forgiven, become taxable, not the entire loan.
Mhm.
So then moving over to supplemental wages, I guess this is a little bit of a hard pivot on loans. Supplemental wages put probably oversimply are bonuses or wages that are not paid in the ordinary course of an individual receiving a salary. Now, there are two ways that supplemental wages are taxed, and those are on amounts less than $1 million during a single tax year and on wages in excess of $1 million in that tax year. For those under $1 million, there is an optional flat rate withholding. The employer can still withhold at the individual's W-4 rate as calculated when they submit all of their W-4 paperwork. And we'll get into a little complication to that in a second. But they could also apply the optional flat rate to supplemental wages, provided that it's not in excess of $1 million. Currently, the optional flat rate is 22%. One important note here is that the employer does not have discretion to change that 22%. It's either 22% or the W-4 rate that's being applied to that individual. The conditions to using that optional flat rate can be found in the Treasury Regulation 31.3402G, and that should also include -1A7. Apologies for that. And the conditions are that the employer has withheld income tax from the employee's regular wages during the same calendar year or the prior calendar year in which these supplemental wages are paid. The supplemental wages are either paid on a separate check or they're separated, itemized on the same check so that you can tell which are supplemental wages and which are their ordinary course wages. And as I mentioned, if supplemental wages exceed $1 million, there is a mandatory flat rate. And so that mandatory flat rate is currently 37%. Again, it's mandatory. There's no option to withhold at the W-4 rate for these supplemental wages.
Mhm.
Now, the wrinkle here is that employees sometimes will want to increase the withholding amount. Maybe they're receiving a lot of supplemental wages, 22% won't cover their expected liability on that payment. And so they'll want to be withheld at 24 or 28% or whatever makes sense for their tax characteristics. And as I mentioned before, 22 is the only optional flat rate. Now, a way around that is that the individual could submit a new W-4 before receiving the supplemental wages that the company then chooses, but does not have to, chooses to apply to the supplemental wage. If this occurs, that W-4, that new W-4, as I'll call it, will govern all of the withholdings after the supplemental wages are paid, unless and until, I suppose, a new W-4 is filed with the employer. So if an individual comes up and wants to adjust or get around that 22% flat rate, they would have to issue or fill out and submit to the employer a new W-4 prior to the supplemental wages, receive the supplemental wages, and then fill out another new W-4 for their go forward ordinary course payments.
A few comments here about payroll and fringe benefits and things. So one thing that many employers get a little bit wrong is when they offer items to employees. And what I like to tell employers is anytime you provide something to an employee, you should consider that compensation unless you can identify why it's not compensation. And if it's compensation, then you should be taxing it. The most practical thing here where this comes up is gift cards. Oftentimes employers might give out gift cards as a reward to employees for doing a good job or a compliment from a customer or something like that. And they might say, here's a $25 gift card. Thank you so much for that. Well, they've just handed the employee $25 in compensation and they should then impute that on their check and make sure they're withholding and properly handling that. There is a rule about de minimis fringe benefits, which is described in this slide. But if you look through this rule in depth or just this slide a little bit, you'll see that it's very, very restrictive as to what you can give someone and not include it in their income. It is super restrictive. The one thing that's a little of an outlier here is an occasional theater or sporting event ticket. But you can try and keep in mind these regulations are from the late 70s, early 80s, before the cost of some of those things went as crazy as they are today. But still, the fact that local telephone calls can be excluded gives you some sense of what it is here, where it is very common these days to exclude those things. So that's something where keep in mind that cash and gift cards are never a de minimis fringe benefit. They should always be reported to the employee's income. If you're not doing that, we're happy to talk to you about it, but that's something to do in terms of having good payroll practices. This slide gets into a little bit more about that cash and gift cards. Basically, it's one of those things where the IRS just views that as compensation. There are some strange things. So at the very bottom here, if you ever need a trivia question or you're asking, what could I do for trivia? You could say that the IRS regulations do allow employers to go ahead and give a traditional holiday ham or holiday turkey to people, but you cannot give a holiday gift card or $25 gift certificate to Coburn's or Cub or Aldi or some other grocery store and say, go get a turkey or anything. That is still viewed as comp. On the other hand, if you have a freezer full of fine, delicious meat products that you're handing out to people, that's not compensation. I can't explain all those things, but that's again, just a traditional thing that was happening before the IRS started doing its regulations. So that's one thing to consider. Also to note, any type of gift really is a form of compensation. So there isn't really something where you can say, oh, I'm just going to give this as a gift to my employees and I can exclude that out from compensation. Finally, generally speaking, prizes are a form of compensation. So if you have like holiday raffles or things like that, those can be also compensation and you should consider how to include and report those in income. There are some different exceptions I've noted here, like qualified scholarships, some length of service and safety awards, and some other things. But generally, prizes are compensation, even if they're prizes received from an employer's vendor and then they're shared with employees. So those would all be things that you'd want to go ahead and include on someone's compensation. We're about 5 months out from holiday party season or things, but that gives everybody time to be thinking about all this in terms of what you might do in terms of any holiday prizes, awards, or raffles, and also transferring gift cards to individuals. So Christian, I'm going to turn it over to you to talk about remote workers, which have remote employees, which has been a big deal.
So I'm going to give a 90-second summary of an hour presentation that Tim and I have done with our labor and employment colleagues separately. And so very quickly, this slide pertains to remote workers. And what we're calling remote workers is really, if you close your eyes and imagine you're a North Dakota company that doesn't really have a presence outside of North Dakota. Maybe you're recruiting some sort of specialized labor. I have in the past dealt with medical coding, and it's difficult to find in a state for whatever reason. And so the employer wants to hire someone from another state that will work remotely from that state, but the employer does not otherwise have business in that other state and is not planning on expanding to that state. Companies should be really considering what this means, both in terms of payroll, in terms of the individual's taxation and reporting to their state of residence, as well as what it means for the company in terms of registering their business to do, or registering to do business in this other state, whether it triggers a corporate income tax. We also have here listed state unemployment insurance in the other state worker compensation. Again, this is a 60 to 90-minute presentation on its own. But hopefully I've impressed upon everyone watching that if you have someone working outside of states where you operate, you should be considering what that does to impact payroll and other tax considerations.
And Christian did a very nice job there in 90 seconds, but I might just add on a few more things here. You know, we had that question that was actually about the prior presentation about, well, would this Minnesota state law apply to us given that we have employees? And that's an excellent question. You know, when you have employees in other states, it's pretty easy to see, even if you only have one employee or two employees, you're gonna have to comply with unemployment insurance or workers' compensation or other things. But then you get into things also about how do I report and withhold amounts to the state Department of Revenue for that other state? So in Minnesota's case, the Minnesota Department of Revenue, right? You also can get into things where the state might have laws that say, hey, if you have 10 or more employees, you need to do this family medical sick leave, or you may need to do this if you have 5 or more employees. In different states, there's different thresholds of when you have employees and what you need to do. And it's not just you know, standard unemployment insurance, workers' compensation. Christian kindly has a few notes here on the slide about things like in Washington, there's this Washington Cares Fund it's an employment tax to fund a long-term care program, right? So that's all at play. But it gets even more complicated than that. I feel like I'm on TV, but wait, there's more. Because even if you have like salespeople or people who are skilled professionals who go to set up a business or do something. So let's say you're in manufacturing and you're opening a new factory in the state of Colorado and you send some really skilled people on your production line to the state of Colorado and they're there 2 months. Guess what? They've now worked in the state of Colorado for 2 months and they probably owe Colorado income taxes on that income. So it's not even having a person necessarily permanently in another state. It's if you're sending a person to another state for a period of time, a week, 2 weeks, 2 months. You need to be worried then again about the potential that that state will know that and that you will be under obligations, especially with respect to state income tax reporting withholding. The final observation I'll make on this slide real quickly is, especially if you have a company where your CEO or chief financial officer goes to New York or other cities to help raise capital or money and spends time there, there are some states, and New York is one of them, that really track who comes to visit their state for how long and wants to capture income taxes. So that's another time that you would want to be particularly alert to, do I need to be reporting income for the person traveling to that state or spending time in that state? So Christian, I think you did a very nice job at 90 seconds, and I'm adding on only because I can't even feel like I got enough in the 90 seconds you gave. So real briefly here, I'm just going to talk about some payroll penalties. Real briefly, I'm sorry, I went too far. Oh, I'm sorry, Christian. I think that I got this out of order.
We have 2 more before payroll penalties, I
I'll let you
believe.
quickly talk about non-qualified plan employment taxes. I apologize.
That's right. And so here we have 2 slides, spoiler alert there too, that talk about non-qualified deferred compensation and how that complicates payroll taxes. And so very quickly, non-qualified deferred compensation, we have compensation that is earned on day 1, but not received until day 2. And for purposes of taxation, particularly employment taxation, it attaches at the later of the date when the service is creating the right to the amount are performed, or the date on which the right no longer is subject to a substantial risk of forfeiture. Now, a substantial risk of forfeiture is determined under Section 83, which typically applies to property transferred in connection with the performance of services. And what this often means is that there is some employment tax that is as I used earlier, attached or realized prior to the individual actually receiving the money that they have earned. There are two examples here on the slide. In the first example, an employer contributes or credits $10,000 to an account balance non-qualified plan, and that amount is fully vested and to be paid later upon the individual's termination. Now, because that amount is fully vested and the services were already performed for them to receive the $10,000, the employment taxes are due when that contribution is made to the account balance, even though that individual didn't receive those $10,000 in their bank account. The second example, slight deviation here, $5,000 is credited to the account balance non-qualified plan, but it is subject to 3 years of vesting requirement, and then it will be paid upon termination. Now, the 3-year vesting requirement is the substantial risk of forfeiture, and so the employment taxes do not attach when the contribution is made as per the first example, but rather when the contribution vests, or put otherwise, the substantial risk of forfeiture lapses. Now, there's a special rule as to when the employment taxes are due under this 31.3121 V2 regulation. And that allows really ease of collecting and paying the employment taxes. As you can imagine, an individual receiving this tax bill without any cash might be a little bit frustrated that they have to be withheld without receiving any extra income. And so this allows the employer to withhold and pay the payroll taxes through the rest of the calendar year during which that the income is realized, or rather, sorry, the employment taxes come due.
Yep. I'm not going to cover the next two slides just due to time considerations here for a minute, but we just wanted to note there are a number of substantial penalties for failing to provide accurate and timely W-2s and 1095-Cs. The 1095-Cs in particular are a place that we've worked with a number of employers who've gotten large penalties from the IRS on them. And so that's been an issue. Christian, real briefly, maybe you want to cover, or I'm sorry, I'll cover this eligibility and then we can dive into a few more things. I won't do this in too much depth either because Meredith had already kindly covered this in a prior presentation. Historically, one thing here now I should take one step back and say, we're moving in now into retirement plans and some practical steps you can take in retirement plans and things you'd want to consider here to make sure you're doing things right and not having mistakes that might be costly to correct later. One of the first things is eligibility. And with eligibility, historically, plans have generally been able to exclude people who are under age 21 who hadn't completed a year of service, which again was generally like 1,000 hours of service. But now there's these long-term part-time employees who have to be covered. If you haven't talked to your vendor or your broker, Fidelity, Empower, whoever you might work with about that, that's something to ask them about and make sure that's done. Two other quick things to consider with eligibility are contractor misclassification, so classifying an employee as a contractor. And there's some rules on leased employees, which we now and then find employers don't fully understand. Christian, do you want to talk a little bit about contributions?
Sure. So employers have a fiduciary responsibility with respect to both contributions and distributions under the 401k plans. We're going to start off, for obvious reasons, with contributions. And where we see footfalls occur is that the contributions that are made by employees need to be forwarded, and loan payments as well need to be forwarded as of the earliest date on which such contributions or repayments can be reasonably segregated from the employer's general assets. And what the DOL has said is that for plans with fewer than 100 participants, reasonably be segregated from the employer's assets has until the 7th business day following the amount would have been paid to the participant. So the 7th business day after the payroll period occurs in which the deduction is made. Now, failure to do so is a prohibited transaction. It requires correction. It requires correcting the operational mistake under the employee plan compliance resolution system. and it requires correction for the prohibited transaction under the DOL's VFCP. Switching to the next slide to talk about distributions real quick. The employers, as I stated, also have fiduciary responsibilities with respect to elective distributions. The DOL has issued guidance on assisting with finding missing participants, making sure that individuals who are owed money from the 401k through distributions don't fall through the cracks. A few high-level points in their guidance. They suggest maintaining accurate and correct data and current data, implementing effective communication strategies, conducting searches for missing participants periodically, and documenting procedures and actions of those searches to make sure that all of the systems are accurate and up to date. Additionally, the code requires minimum distributions. Right now, as my colleague Meredith pointed out in our last presentation, the minimum distribution is set at age 73, set to begin at age 73 unless the individual is still currently employed at that date. That age actually increases to 75 in 2033. It's quite a while from now, so perhaps there will be some change before then. But as of right now, it's slated to go up to 75 in 2033. And then, of course, failure to address any of these chronic issues with having participants go missing or with failure to make the required minimum distributions can result in DOL or IRS action.
So I think one thing we'd encourage employers to do is it's very easy. You have employees who come and work for you. Maybe they don't even work for you that long. They get some money in the 401k plan. They leave, but they've made elective contributions and it's something that just lingers in the plan, or they've worked for you for a while and they've got more than the small amount cash out level. So they have a little over, say, 7,000 these days, and you go ahead and just leave them in. In some ways, you say, well, that's not so bad. We have more assets under our plan, so we may be getting a little better fee breaks or something, our investments. Excuse me. But the hard thing is that the longer it goes when a person leaves your employment, usually the more difficult it is to try and track that person down. So probably a best practice here would be, if you haven't conducted one of these recently, go to your vendor, your Fidelity, your Empower, whoever, and ask them for a list of all the terminated participants and what the account balances are, and see how many of those people have bad addresses, and then you can try and do a search for them. Excuse me. That should help you go ahead and clear that up and avoid having people who reach age 73 when you have to do those minimum required distributions. Finally, excuse me again. One of the things that employers really should do if they have 401k plans is focus on how are they managing and handling the investments under their plans. I'm sure all of you have seen there's been litigation ongoing for 15 or more years now about, is a committee or is an employer doing a good job of supervising the investments in its plans? Many employers have a 401k plan and they comply with what's known as 404C of ERISA, which basically says to people, hey, as long as you have a committee or a fiduciary that's done prudent choices, if you choose a fund then that doesn't do so well, that's on you, employee. And so that's how many of these 401k plans are designed. But that's all predicated on the employer or the fiduciary going ahead and doing a prudent job of selecting, monitoring, and terminating the funds offered to the participants. And so what you really need to do there in order to set yourself up in a good place is think about a prudent process. And what is a prudent process? Well, there should probably be a committee. It could be just a person, but usually a couple of people or 2 or 3 to oversee the investments in a 401k plan. That committee should then meet a couple of times a year, maybe 4 times a year, and should have an outside advisor who talks to it about the investments and says, yes, these are appropriate, or no, these aren't. It wants to have some documentation to show that indeed these are investments that it was monitoring and consulting with experts on in terms of keeping them in the plan. It wants to find investments that have low or no cost to the participants, as low as you can. And obviously in smaller plans, that's more difficult because you have fewer assets under management. But the lower the 12B1 fees, the less likely it is that there might be some litigation that the committee or the plan didn't do its work. And finally, the committee should document everything it does to try and make sure it is prudently selecting, monitoring, and terminating those investments. This is a really important thing. If you're not doing this, or if you don't have a structure set up, I'd encourage you to set up a structure and find a way to do this on a regular basis to show that you are handling this. And then if there ever should be litigation, you're putting yourself in a much more strong place. Plus, in terms of a governance thing, all of you folks are participants in your 401k plans too. You probably want to have the best process in place possible. And so that's a helpful thing to do. So those are our sort of practical advice tips. We hope that you enjoyed this presentation and the other two presentations, and really appreciate you taking the time today to attend the seminar. If you have any questions or things, do feel free to follow up with any of the presenters who presented today. The contact information is in the slides. In addition, on the slide here, there's information about the credits, questions, materials, and sign-on, so that's all available to you as well. Finally, if you have any suggestions about future presentations, also feel free to follow up with us. Thank you again for your time and have a great rest of your day.